Hey traders, I promised that if I had time I would do a video on bank earnings. They start this week, and this is the XLF, which is the sector ETF. There are other ETFs, but this one is pretty liquid. This would be the one I would use. So JPMorgan starts Wednesday before the open. So today is Tuesday. That's the last day to trade it beforehand. Then we have, I think, Bank of America, Wells Fargo, and Citi, and Morgan Stanley. They're stacked. Usually there are like 2 or 3 first day, and then 2, and then skip, and then another one. But this time around, JP Morgan is biting the bullet. So here's my take in general. Since this one is reporting first, I wouldn't trade those options. I would use these options to bet on this one. And first of all, the potential move plus or minus is very limited. Statistically, they promise to move about 2.5%, but they don't live up to it. Let me see if I can show you that. This right here, 2.6% is the implied average move. So before the earnings, this is what we think they're going to move based on the options, and this is what actually they moved. So it should be a reaction to the earnings. Quality company. That should be boring. Therefore, I wouldn't expect to buy calls in order to get rich off of them. It could happen, but the odds are against it. So it should be a boring trade. I looked at the open interest. It has support and it has resistance, but it has leeway on both ends. So there's no intelligence from that. There's no obvious downside pressure or upside pressure. So this is where you go with gut. And I say this because it's a bet based on gut and not based on financials. In other words, if you think highly of the bank, which the whole world does, it doesn't mean it's going to move up because of the report was so good. In fact, let's see. This is a daily. Let's go to JP. And let's see here. Last earnings report, they fell. Not violently, but they lagged and then fell. Before that, they popped and dropped. Before that, they just dropped. Before that, dropped a couple of days and then recovered. So not a reaction. This was way back in July of last year when they popped, but we were coming out of a pandemic. So there's no need for it to pop here. And in fact, if it falls into 160, it would make sense from a perspective. 162.5, 160, I'd be a buyer of this chart. So maybe I'll put an alert. So technically speaking, earnings aside, if it fades into here, it's a buying opportunity to catch the falling knife, but it's not an investment opportunity because it's still too high, way too high for my book. Now, they're very liquid, they're very rich, but their income statement is not as exciting as, say, tech companies. You can see it. So where's the exuberance for an all-time high as a base for more highs? So I'm not rushing into it. In fact, the only one that looks like it has upside because it just lost some, maybe Goldman Sachs, but they move in unison. So if I wanted to bet on JP Morgan using options for this week, I would, again, use something else. Why? Because on the morning on Wednesday, when it opens and they report, the the premiums for those options will disappear relatively to how expensive they are now. But I looked at that, and even those are boring. So let's get out of this window. This is this week's options. The implied volatility for JP is 32%. 35, let's call it, something like that. So if I go out in time, it's 29 or 25. So it's not that big a difference, but it is a difference. So this scenario, see the difference between current and usual? There is a difference. So every call, every put I buy here, I'm overpaying that much. That's significant. At the open tomorrow, this will go down to here. So I will lose money just from the open because the event is gone. Well, if I go to Goldman Sachs, that differential will stay there because it hasn't reported yet. That differential won't drop tomorrow morning because its earnings are 3 days later or 2 days later, whenever. So that differential will stay. So if I pick wrong, or if nothing happens, my premium is not, I'm not going to lose money just from the open. Whereas Same with Bank of America. That differential will stay there. They will stay expensive until their event is gone. So that's how you game it. Okay, so if I bet on JP and I guess right, I will win faster than betting on Bank of America, for example, to play the JPMorgan report. But it's a give or take. So I give up a little bit of upside if I guess right, but I take away a whole bunch of immediate losses from this. This is a fact. At the open on JPMorgan tomorrow, this will collapse. They call it the implied volatility crush. Whoop, comes down to here. So what's the difference? 8 points over a base of 26. That's a big percentage drop. That's how much extra I'm paying today because I want these Nike shoes today. Tomorrow's going to be cheaper. So just from the fact that the event is gone. So be careful of that dynamic. They're not a happy rally group, although they have rallied. So fundamentally, they are solid. They're cheap, but they've always been cheap. They are more expensive than they have been. So you can argue pluses and minuses. So it's all about expectations. What are people expecting? I know what I'm expecting. You know what you're expecting. You and I don't know how many people are like you or like me or different than us. So it's all about expectations. If you call the CEO and say, guess your stock tomorrow morning, they have the P&L, they have the balance sheet, they have what they're going to say in the conference call, and they know what they're going to answer, and they have the insight on their stock, they have no clue as to what the stock's going to do the next day. No clue. It has almost everything to do with expectations and almost nothing to do with fundamentals. Short-term, open, pop, drop, overnight rally. It's all about expectations. Longer term, whatever they deliver in the report will matter, of course. But if you're trading the action off the earnings, like, oh, I think they're going to deliver a great report, I'm going to buy calls, you're making a mistake. You can't say it's going to be a strong report, it's going to be up. You don't believe me? I'll offer you proof. I've said it many times. So, Apple, when was the last time it delivered a crappy report? Years. You can say the same about any tech company. Why is it that it's a coin flip reaction on every earnings report? This one's drop. Was the report crap? It was not. It was gold. Was the report crap? It was not. It was gold. Those are two drops. This one, a big drop. The report was great. It was not crap. It was the expectations that were out of whack. So I have confidence that people will mess up the expectations. That's just one company. You can pick any, and it's a coin flip. And they're solid reports every time. It's all about the expectations short term. Eventually, they'll find footing and set new highs. So if the report is good, but overnight and for the same week, it's not a price driver, the quality of the report or the lack of the quality. It's the expectations. Okay, it's going to be great, but how great? And what are people expecting? If people are bracing for impact and it comes out okay, they'll have a relief pop on an okay report. So anyway, beating that notion to death. So line them up and see how you want to trade them. Wells Fargo is the black sheep of the family there. So maybe Wells Fargo and Goldman Sachs are the most exciting because they might act like tech stocks at some times because they're not boring. Bank of America is boring. I'm afraid of a real estate bubble, and that would put Bank of America and Wells in the line of fire. I don't think Goldman Sachs is in the real estate market yet, or JP to a certain degree. So the other two are more traders. So the wild card is Citigroup. Tends to be, in my opinion, international. So do they have exposure to Chinese equities, properties? So if that's the case, maybe they say something bad. I have no idea. Do your homework. But Citigroup above 74 will find buyers to get to 77. It has the wildest open interest of all of them. So maybe there is some movement there. I don't know what they're going to say, but maybe they have some overseas exposure to China, or maybe they dispel it. They say we have no overseas exposure to China, and the stock will react in jubilee, whatever. We'll be happy about it. How about that? Okay, so let's see if I can give any other. I picked up. I didn't mess around with the smaller ones. Morgan Stanley, I almost never look at it. I probably should. Okay, so if it loses 96-ish, it should come down to 92, at which point it would make a nice buy the dip opportunity. So if I trade it here bullish, I'm guessing it's going to hold. Versus if it falls to here, I'm not guessing. I'm going against the thesis that it has support, it should hold without a headline coming to ruin it. Here I have the guesswork of a headline that could ruin it. I know if it goes above 101, it should find some buyers to pop up to like 103, where it's going to have to battle its life away here to break into highs. So a drop into here is a blind buy. So these are my lines to trade. Maybe I can put one here too. Trading ahead of the earnings right here is guesswork. Trading right here is calculated risk with better odds. So that's why I don't like to trade the earnings. I like the better trade is after the earnings. All right, so what else do we have? City, I said. So Delta, that's a different conversation. All right, so that's it for me. I'm not trading the earnings on banks. I almost would want to like use the S&P, because if banks are rallying, chances are the S&P is rallying too, minus the headline risk of banks. Also, the TLT, if the TLT rallies, the banks might fall from that. Because anyway, longer conversation there. Too many question marks around earnings. It is tradable, but believe it that it's a guesswork short term. Long term, you could be right. Signing out. Hopefully this helps. Let me know.